This topic is about the process of analyzing financial statements for decision making. It actually involves using the information coming from our financial statements, process that further so that we can come up with a new, more relevant information which will be used for decision making. Now, normally, we would ask, why do we have to analyze financial statements? Okay. One of the reasons why we analyze financial statements is that, well, because we'd like to learn what happened from the past. Okay. And aside from that, okay, it will also help us understand what is happening in the present. And of course, it will help us decide for the future. Now, normally, the question will be, how do we start? No? How do we start analyzing our financial statements? Before you start computing the ratios, okay, preparing the trends and your charts, okay, the first and the most important part of analyzing your financial statements is called the background analysis. Here, you're going to understand what happens, no? What is happening around the company. So you can start with the economic analysis. Now, actually, what I recommend, for students is to use the top-down approach, okay? Which means you start analyzing what is happening globally, okay? And then on a national level, understand the industry up to the time you understand or you analyze the performance of the company. So for top-down analysis, we usually start with the economic analysis. Under economic analysis, okay, you understand what is happening in the economy, okay, where the company belongs to. Once you have an idea, okay, once you have an idea on how the economy performs, you can now go to industrial or industry analysis. You should also understand what is happening to the industry where the company that you're about to analyze, okay, belongs to. Why? Because soon you're going to set standards. You're going to make comparisons. And you cannot compare, okay, a company to another company belonging to a different industry. Or you cannot assess your performance based on a different industry's performance. Okay? So you have your economic analysis, industrial analysis, and then finally you have your company analysis. Okay? So for example, if you are analyzing the performance of, let's say, Jollibee as your company or McDonald's, you should understand what is happening in the industry or in the fast food industry. If you're analyzing the performance of San Miguel beer, then you should also know what is happening in the foods and beverages. Okay, so ayun. San Miguel Beer, okay, which is located here in the Philippines, assuming that their only operations is here in the Philippines or their main market is Philippines only, then you should also understand what is the economic status of the Philippines. Now, if you try to read other books, okay, background analysis is further simplified into analyzing um, your external factors and internal factors. When we say external factors, what is happening outside the company? And internal factors, what is happening, okay, within the company? In economics, you would normally hear macro analysis and micro analysis. It's the same thing, no? In some management books, you have your SWOT analysis, okay, analyzing the strength, the weakness, the opportunities, and the threats, okay, in our company, okay. Now, if you try to put this together, actually, you will come up with something like this. Let me get my pen, okay. So let's try to use a red pen for this discussion. Ta-da! There you go. Now, if this is an inverted triangle, okay, you divide this into three, and this is now your top-down analysis. Okay, you have your economic analysis on this side. Okay, you have the industry, and then you have the company analysis. There you go. Now, what about macro and micro analysis? Let's try to use a different color to make this more interesting. For macro analysis, it normally involves analyzing the economy and the industry where it belongs. Ayun. While for micro analysis, it involves analyzing the company's performance. So that is now your micro and macro analysis. Okay. What about for external and internal? The same with macro and micro. So let's try to use a different color for our pen. Maybe let's use green. Ayan. Because they are almost similar. Okay. So, ayun. Pareho lang pala. You have your internal and external. So they are almost the same. And for your SWOT analysis or your TOS analysis, okay, let's use a different color. Maybe let's use blue. Okay, your threats and opportunities will normally come and from this part. Okay, your economic analysis and your industry analysis. While your weakness and strengths, okay, will be identified under company analysis. So that is now your top-down approach. If you want to understand the performance of the industry, you have to compare that with the economic status. You have to understand this first. If you want to understand the company's performance, you have to understand the industry where it belongs to, okay, and the economy where it operates. Okay, so that's your background analysis. Now, why do we have to focus first on background analysis? Well, it helps us set standards. When we talk about standards, okay, you can have your historical or target standards. When we say historical standards, these are standards that are set, coming from the performance, okay, in the previous years. Okay, so that's why it's called historical. When we say target standards, these are standards based on what we'd like to happen in the future. Now we also have your book and market standards. When we say book standards, this is based on the information coming from the company, from its own books. When we say market standards, this will come from the information coming from the industry, okay, or coming from the market. Now, if you try to combine these concepts together, there are actually four kinds of standards: your historical book standards, okay, coming from our own books, from the company's information, from it, based on past performance. You also have the historical market standards. Okay, this is what happened in the past, based on market information. You also have your target book standards. This is what you want to happen in your company. Okay, and you have your target market. Okay, the information will be coming from the market. This is what we call your benchmarking. When your standard is based on what you'd like to happen, based on what is happening in the market. Ayun, parang ganon. Now, after setting our standards, okay, another reason is financial statement analysis will also help us evaluate our current performance. So standards is your should be, and your actual or your current performance is your actual performance. So you can compare these to and come up with your variances. Also, financial statement analysis will help us in forecasting, in budgeting, and for financial planning. Now, I've been talking about comparisons, no, and background analysis. Why is comparison important? Let's have an example. Now, let me try to choose another color. Let's say I want a red. Ayan. Para masaya lang. Let's assume that this is, let's say, your sales for the past few years. It's going down. Let's divide this, assuming this is year 1, year 2, year 3, year 4, and year 5. So at the end of year 5, this is now your sales. Is this favorable or not? Normally, no, normally students will say it's unfavorable because the trend is going down. Okay? Now, that is if we are just looking at the sales of our company. But for example, if you're now going to compare, no, your sales with the average sales of companies belonging to the same industry, these are their sales for year 1, sales for year 2, sales for year 3, year 4, and there's no sales for year 5. So now question, if you are this company, let's call this company A. Do you think that's favorable? Well, for me, it's still favorable because as of this point, your competitors are already dead and you're the only one remaining or operating in the market, which means you now have an opportunity. You can apply the concept of last man standing. Or for example, let's have another example so that you can understand the concept of comparison. Let's assume that this is your net income for the past years. Okay? It's increasing at an increasing rate. All right. Okay, normally you would say that this is favorable for company A. Okay? So let's say that that is favorable for company A. But for the industry, okay, assuming this is the performance of the industry, okay, for year 1, year 2, year 3, year 4, year 5, year 6, and year up to year 10. Ayan. Do you think your sales, or assuming this is your net income maybe, okay, do you think this is still favorable? The answer is no. Although it is increasing, it's way behind the industry's performance. Okay, so that's how important comparison is. Now, to continue, what are the areas in financial statement analysis? First, you have your liquidity. Liquidity is basically the company's ability, no? Normally this is defined as the company's ability to pay short-term liabilities. But in finance, no, in finance or in actual practice, we normally use the term liquidity, okay, to refer to the company's ability to pay near-term demands. So when we say near-term demands, it doesn't only include current liabilities, but also upcoming expenses. Like, for example, if let's say you have a current asset of 500,000, let's try to write that down. A current asset of 500,000, and you try to compare that, no? Mahirap magsulat sa mouse. And you try to compare that with your current liabilities. And let's say your current liability is only 100,000. There you go, 100,000. You can say that, oh, we have a ratio of 5:1. And you can say, aha, this is favorable initially because for every 1 peso of our current liabilities, we can pay 5 pesos. Okay, but assuming, no, assuming that 3 months from now you're going to pay rent amounting to 200,000. Okay, you're going to pay some utilities of 100,000. You're going to pay salaries and wages amounting to 500,000. Then your 5:1 is not enough. Okay, so although 5:1 will indicate, oh, we have the ability to pay 5 pesos for every 1 peso of our current liability, but we may not be liquid enough to support our operations. That's why I prefer using the term liquidity as the company's ability to pay near-term demands. Okay. Now, if you have liquidity, you also have solvency. What is solvency? It's the company's ability, in some books, no? The company's ability to pay long-term liabilities. But in practice, this is actually the company's ability, no, to pay long-term demands. In some books, they don't use the term solvency. Instead, they use the term stability. Okay, let me write that down. Stability. And when we say stability, this is the company's ability to operate on a going concern. Are they the same? It's yes and no. Okay, if this one is your ability to operate on a going concern, okay, this one is your ability to pay long-term demands. But if you have the ability to pay long-term demands, okay, the business risk will be very low for you. Therefore, you now have the ability to operate on a going concern. That's why they use solvency and stability interchangeably. Okay, we will have more discussions about that in the future. You also have profitability, which refers to the company's ability to generate profits from its operations. Normally, we use the accounts coming from your income statement. Here, we analyze your gross profit, your EBIT, your net profit margin. Okay. Um, Ayun, that's how simple your profitability is. Okay, take note. Ability to generate profits, okay, coming from your operations, coming from your business. But if you try to include, okay, the use of your assets to generate profits or revenues, that's now what you call asset management or asset efficiency. Your ability to generate revenues, okay, based on how you use your assets. Okay, so that's your asset efficiency. In financial management, okay, this is more discussed in working capital management. Okay, so you have uh, how good you are in using your inventories, your accounts receivable, okay, and the like. Also, another area will be marketability. Now, this is not your ability to market your products, but instead, this is your ability to generate values, no? To generate values or to create values for your stockholders or to your shareholders. Okay, here we will be talking about the value of your investment, okay, the value of your stock, okay, and how they affect the value of the company. Okay, now also, there are methods in analyzing financial statements. What are the common methods? You have your time series, okay, also known as the horizontal analysis. Under time series, you have the basic increase-decrease method, also known as comparative financial statements. Here, we compare 2 years, no, of operation. So you're going to use the financial statements for year one and year two. And if you're using more than 2 years, normally we use 5 years, okay, and above, you now have your trend analysis. Okay, so those are your methods for analyzing financial statements. You also have your cross-sectional analysis, also known as vertical. Now, why is time series called horizontal analysis? Here, you're going to analyze the changes that happens, okay, in different years. That's why it's called time series analysis. Okay, you want to come up with a trend. For cross-sectional analysis, you want to analyze what happened, okay, in a certain point in time. So your chart will be more of, you know, a pie chart. Yeah, so that's now your cross-sectional analysis. Okay, some ratios, okay, will also belong under cross-sectional analysis. Okay, we'll have more discussions about that, but we'll have a different discussion for a ratio analysis. This is when we try to look at the relationships, no, of the different accounts found in our financial statements. Okay, and then if you'd like to look at the relationships of these relationships, no, or of these ratios, you now have your DuPont analysis. Okay, and that will be discussed in a different presentation. Okay, limitations of financial statement analysis. One of my favorite limitations, take note, these are just numbers. These are not absolute measures of your performance. Why? Because there are still other factors that you have to consider. It's like your grade, no? A student's grade may be 95, while another student may have a grade of, let's say, 89. Now, are we saying that the first student is more intelligent? Well, based on numbers, yes, but take note, these are just numbers. These are just their grades. There are other factors that you have to consider. Like, for example, now, in our COVID, um, do we call it COVID season? Ayan. Where we are having online classes, okay, malay mo, this student has a poor internet connection and this one has a quick access to Google during exams. Also, another limitation is the heavy dependence on historical cost. Well, because financial statements are prepared, okay, using the historical cost basis. We don't record transactions that will happen in the future. Okay, but there's only I think one exemption for that, no? Okay, if you have your contingent losses, okay, this is actually a discussion in your FAR. If a contingent loss can be estimated and highly probable, then you can already record that. Okay, a contingent loss is a future loss which is dependent on the happening of a condition. Aside from that, okay, there's no other future transactions that you can record. Okay. Now, your financial statements doesn't consider inflationary effects, although there could be adjustments, no, in our retained earnings. Okay, but um, there are limitations when it comes to adjustments for inflation. Okay. Also, it's not always comparable across companies. Even if we have your common size financial statements, the common size financial statements can only address the issue on size but not on the type of company. So like for example, okay, you can actually use common size financial statements to compare Wendy's and McDonald's. They have different sizes, but they belong to the same industry. But it's hard to compare, let's say, the performance of, let's say, BPI, Bank of the Philippine Islands, with that of San Miguel Beer. Why? Because they belong to a different industry. And of course, your financial statements are subject to fraud. I guess this one is self-explanatory. And then, okay, not all of the time your financial statements are verified. And although there are audited financial statements, but still, okay, um, it does not give us a it doesn't give us a guarantee. Okay, even if these financial statements are audited. Okay, so that's a quick discussion for financial statement analysis. The details for the methods, okay, and areas will be discussed in different presentations. As of this point, okay, this is what I think is relevant, no, in our subject, which is financial analytics.